Hey everyone, there has been a sharp correction in the Indian stock market with Nifty 50 correcting around 12%, but mid-cap index down 18% from all-time high and small-cap index also down around 18%. I was looking at the total number of Demat accounts in India that zoomed from 4 crore during March 20 to nearly 18 crore now. It means 3 out of every 4 people have started their stock market journey post-COVID. So technically, this is their first stock market correction. And majority of new investors were only focused on small cap mutual funds because of high growth. And today, small caps have corrected the most, leaving everyone confused in terms of what to do now. So here, I want to tell you that this is not the first time we have seen a correction in the market. This correction is part of our investment journey. Equity markets have been volatile in the past and will remain volatile in the future. But in spite of all the corrections, if you look at the long-term trajectory, it's always towards an upward direction. So there is absolutely no need to panic. Another point I want to make is there are a lot of discussions around closing the SIP. But in my honest opinion, SIP is the best tool to invest in equity market because nobody can time the market. I clearly remember during COVID when market tanked sharply, a lot of people stopped their SIP. Some even withdrew their money. But then we saw a massive rally in the market and they lost one of the biggest opportunities of their lifetime. Today also some of you might be feeling like stopping the SIP or withdrawing money and investing it later. But trust me, by the time you realize that now is a good time to invest again, the market would already be touching an all-time high. So don't stop the SIP. It is for your long-term goals and it will definitely reward you in the long term. Especially you should continue your SIP when there's a correction in the market so that you invest money at lower levels. Now I get a lot of requests from people who want to utilize this volatility or rather correction in the stock market to deploy their money. So in my opinion, this correction in 2025 has created an excellent opportunity to deploy money in equity mutual fund in a systematic manner. Having said this, it's very important to balance your risk and reward while investing your money. That's where in this video, I'd like to suggest 3 mutual fund categories that are worth considering in 2025. Alright, let's get started. So first mutual fund category is index fund. I've discussed this category multiple times in the past. And there are 2 key reasons to invest in Nifty 50 index fund. First, large cap index in India is trading at a decent valuation with a PE of around 21, which is near the historical median valuation. So the risk reward is much favorable in this category in this volatile market. Even if there is further correction, I don't expect more than 5-10% correction because the valuation in large cap index are already reasonable and another 5-10% correction would make the valuation quite attractive. And history suggests that whenever Nifty 50 valuations have fallen below PE of 20, it has created great wealth from those levels. Second reason to pick Nifty 50 index fund is due to its low cost structure. One very important parameter while selecting a mutual fund is expense ratio. Nifty 50 index fund has very low expense ratio in the range of 0.1 to 0.2% as compared to active funds expense ratio of 0.5 to 1.5%. While the difference may look very small, in long term it creates a huge difference. Another very important aspect is a lot of active mutual funds actually fail to beat the benchmark. Today, majority of retail investors start SIP based on past performance, often shortlisting funds that have generated highest return over the past 1 to 3 years. But there have been many cases where after 2-3 years, they realize that their mutual funds are not doing well and they get confused whether to sell, hold or continue the SIP. This is the core challenge with active mutual funds. While some active mutual funds will outperform, there is no guarantee that the ones you invest in will continue to do so. That's where your index fund comes into picture. If you are confident about India's growth story, you must have Nifty 50 index fund in your core portfolio. Please note that I am not completely against active funds. You can still allocate a percentage of your portfolio to active funds, but a good allocation should be in index fund. And remember that index funds are also dynamic in nature. If a company underperforms, it is replaced by an outperformer, keeping the index fund aligned with market trend. So you don't have to worry about replacing the underperformers. It would be taken care by index fund itself. As far as returns are concerned, in the last 20-30 years, Nifty 50 has generated around 13% CAGR return and I expect that over the next 10-20 years, it should generate similar return. Now let us look at some of the top Nifty 50 index funds of India. So there are many index funds available in the market and they all have more or less similar kind of returns. And rightly so because all replicate Nifty 50 index. So you can choose any index fund as per your preference. The only parameter that becomes important here is expense ratio. Lower this number, better this is. For instance, Axis Nifty 50 has an expense ratio of only 0.12%. And then you can drill down further to get details like the sectoral breakup that has got 34% exposure in financial sector, 14% in technology, 10% in energy and so on. And then you can see the stocks with highest weightage. This is by free float market cap. While Nifty 50 is a great investment option, the only issue with Nifty 50 index fund is it do not have exposure to mid and small cap stocks that have high growth potential. Of course, it comes at its own risk of volatility. But having some exposure in mid and small cap along with large cap would provide a very fine balance in terms of stability and decent growth from large cap and potentially high growth from mid and small cap. The biggest challenge here is how should you allocate funds across large, mid and small cap? And obviously, it's not easy to pick individual stocks. That's where I like multi-cap fund category. Here you have a benchmark called Nifty Multicap 50-25-25, where 50% would be invested in large cap, 25% in mid cap and 25% in small cap. That way, it helps in providing a nice diversification to your portfolio and balances your risk and reward, where large caps provide stability, mid cap offer growth potential and small cap can deliver high return over time. If you look at the returns, in last 5 years, Nifty Multicap 50-25-25 has generated 21% return versus Nifty 50 returns of 15.8% and Nifty 500 returns of 18.18%. However, the problem is Nifty Multicap allocation of 50% in large, 25% in mid and small cap each is very rigid. That's where rather than going for passive investment route, I prefer active investment route in multi-cap fund. SEBI mandates that multi-cap funds must allocate at least 25% of their asset in each category, that is large, mid and small cap. It means remaining 25% is up to the fund manager to decide. And that's where well-managed multi-cap funds can generate a decent alpha over Nifty 50 and Nifty 500 index. The question is, how do you identify good multi-cap funds? So you need to look at two things. First is lower expense ratio. Needless to say, lower the expense ratio, better it is. And second is risk-adjusted return. So it's not just about generating the alpha over benchmark, it's also about having lower volatility. Here the goal is to identify mutual funds that not only generate good returns but are also less volatile. And one ratio that you can look for risk-adjusted return is Sharpe ratio. It is a measure of risk-adjusted return showing how much excess return an investment generate per unit of total risk measured by standard deviation. In simple words, higher the Sharpe ratio, better the risk-adjusted return. If you look at some of the top mutual funds in this category, it includes Nippon, Kotak, HDFC, Axis that have not only got a high Sharpe ratio but have also generated high alpha as compared to benchmark. Here if you click on Axis Multicap that has done very well, you can get the portfolio breakup with 42% allocation in large cap, 27% in mid cap and 24% in small cap. You can further find the sectoral breakup and top stocks in the portfolio. Then third category I would suggest is Flexi Cap fund. The key difference between a multi-cap mutual fund category and flexi-cap category is while multi-cap funds have a limit on minimum 25% allocation in large, mid and small cap each, whereas flexi-cap has no such limit. So fund manager can decide how much allocation to keep across large, mid and small cap. Here the top mutual funds are HDFC Flexi Cap that is a Sharpe ratio of 1.13 and has generated alpha of 7.3%. One of my most preferred pick in this category is Parag Parikh Flexi Cap that has a Sharpe ratio of 1.03 and has generated an alpha of 5.6%. So in this video, we discussed 3 mutual fund categories that you can consider investing in this volatile market. Nifty 50 Index Fund, Multi-Cap Fund and Flexi Cap Fund. Nifty 50 Index Fund is a passive investment category that would mirror the growth story of Indian economy. Whereas within multi-cap and flexi-cap category, I like the active fund route where fund manager can provide a good risk-adjusted return by identifying large cap opportunities that provide stability to the portfolio and also identifying opportunities from mid and small cap segment to generate that alpha in the long term for the investors. Needless to say, if you are a long-term investor, there's no need to panic from this correction. In fact, this correction is a good time to consider investing in mutual funds at lower NAV. Now tell me in the comments which mutual funds are part of your portfolio. If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.